Hello friends, welcome to my 10 cent. In this video, we will talk about a very important question. A very important question for all equity mutual fund investors. Large cap funds versus index funds. What are large cap funds? Large cap funds are those equity mutual funds which have to invest 80% of their corpus into large cap stocks. And what are large cap stocks? These are the largest listed companies in the country. For example, HDFC Bank, Infosys, Wipro, TCS, so on and so forth. Technically speaking, large cap stocks are those stocks whose market capitalization rank from 1 all the way till 100. The top 100 companies are large cap stocks. Now, large cap mutual funds have to invest 80% of their money into large cap stocks. And what are index funds? Index funds are also called passive funds. They invest as per an index. Now, the index can be a Sensex, can be Nifty. Unlike a large cap equity mutual fund, where the fund manager has to do a lot of research, where he's got a full team. They track different stocks, they study their earnings, they figure out which will do better. In a large cap equity mutual fund, the fund management does all this work and selects a stock, whereas in index fund, they just have to mimic an index. So there is a Sensex, which is the top 30 companies in the country. Whatever are those top 30 companies, an index fund just invest in that ratio as per the Sensex. Hence, they're called passive funds because the fund manager do not play a very active role here. So that's large cap and that's index. Now back to the question. Large cap versus index funds. Before we answer the question, we need to understand the history of index funds a little better. Index funds were popularized in the US by a man called John Bogle. He's known as the father of passive investments. In 1976, he launched the first index fund under his Vanguard group, which went on to become so popular that today index funds are amongst the largest shareholders in companies in US. In fact, it is said that between Vanguard, BlackRock, and State Street, which are the top three index fund providers in the US, they have a massive shareholding in probably 8 to 10 out of the large companies in US. And why did index funds become so popular? In an active mutual fund, the fund manager charges you between 1 to 2% every year for managing your money, whereas an index fund charges a fraction of it. An index fund charges between 0.2 to 0.4% for every year for managing your money. Now, John Bogle felt that in the large capitalization space, in the large cap space, it is going to be very difficult for the fund manager to beat the market, the general market, on a consistent basis year on year. And hence he launched these low-cost funds. He felt it is not worth paying up for the active manager role. And over a period of time, that's exactly what happened. Index funds became so popular that they were consistently able to beat returns than many of the large cap stocks. Now the question, will the same happen in India? If you look at the history of large cap mutual fund investment in the last 10 years, you can find that initially, right up till 2017, by and large, the top large cap funds were doing much better than the index funds. There is Sensex Plan and Nifty funds. For example, all the big mutual funds have their own index funds. Okay. Till 2017, they were all doing much better than index funds. But then 2017, something happened. What is that? SEBI came up with a circular which defined the scope of all large cap funds. SEBI came up with a circular that said that all large cap funds, by definition, need to invest minimum 80% of their corpus into large cap stocks. Now, what was happening till that point was a lot of these large cap funds used to call themselves large cap funds, but were very generous in investing down the curve into small and mid cap, and hence they were able to generate a slightly better returns. Now, that is not exactly right, is it? Because SEBI's argument was, if you're calling yourself a large cap funds, then your investor is investing in you with a certain risk perception or a certain perception of a safety, that you're predominantly going to be investing in large cap stocks. And if you don't do that, then that is not right. And hence SEBI came up with these guidelines. Now, that was a game changer. Because once SEBI put a restriction that 80% of the funds have to go into large cap, then the portfolio of large cap stocks started looking very similar. Most of the large cap stocks started looking very similar because they typically tend to operate into the top 5, 10, 15, 20 stocks. And index funds, whether it is Sensex or Nifty, are again the top 30 to 50 companies that we are talking about. So as a result, what has happened from 2017 onwards, and particularly last 3 years, index funds have started giving a run for money to the large cap stocks. With such a huge overlap of the shares that you're investing, large cap stocks have struggled massively to cover up that extra charge that they're doing every year. Large cap stocks under regular plans, large cap mutual funds under regular plans charge almost 2% every year as management charges, whereas under a regular plan, the index funds charge only 0.4%. And the large cap fund managers have struggled to generate that extra 1.5% just to cover up the cost. So if you can see, as you can see in the table and the charts we provide, the last 2-3 years, index funds have done consistently equal or better than the large cap funds. So my personal view, or our view at My 10 Cent, is in times to come, index funds are going to dominate, are going to repeat what has happened in the US. In India, index funds will dominate the large cap space. I think the verdict is very clear. I think the large cap space is going to be very difficult for active fund management. It's only a matter of time before it gets converted completely into index funds. And I have hence started including index funds in my portfolio of large cap equity mutual fund investment. Now, if you're wondering which index fund to invest, it doesn't honestly matter. All the top fund houses have good index plans. There is typically Sensex plan and a Nifty plan. You can choose whether it is HDFC Mutual Fund House or ICICI or SBI. All of them have index funds launched. And it doesn't really matter which index fund you launch because they all track the same index. They will give returns in the same ratio. Pick the one with the lowest expense ratio. Pick one which charges the least for fund management charges. Just go and check the fund manager charges and pick it up. So the verdict of the question is very clear for us at My 10 Cent. Index funds versus large cap. There is no more a question versus anymore. Index funds is here. They are here to stay, and they are here to give large cap funds a run for their money. If you like this video, please subscribe to our channel. Please share it with your friends, and I'll see you in the next video, where this is a full series where we will be covering about flexi cap funds, large and mid cap funds, and mid and small cap funds. Watch out for those videos. In the meanwhile, stay invested, enjoy returns, read our channel, or you can check our Facebook account, our website, my10cent.com, and I'll see you in the next video. Bye-bye.